This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Good afternoon, Ed.
Good afternoon, Aaron.
Let's maybe take questions on the newsletter itself before we get into the table of contents. So, Bruce, he asks, what happened to San Mateo County?
Sorry.
Yeah, it's just difficult to do every single county. We try to cover some of the most populous, and we don't get to all of them. So, yeah, we got similar. Josh, sorry, Ventura County, we didn't cover as well. We did add Fresno, though, in the last year.
We do have it in the report. I know we have Ventura in the report talking about all those things, and I don't know about San Mateo, but I know Ventura is.
Yeah, I agree. All right. Do you have any other off-the-cuff thoughts about Ventura? Josh wants to know.
Josh, without it being in front of me, I don't feel there's many areas that are completely maxed out in price. And I guess that's when we talk about what's next about 10 days from now. The least important thing will be the short term, which means in the next year. What'll be important is the decade that follows, because there'll be game-changing events that just make the outcome different. So if you're asking me, do I feel an urgent thing to sell something in Ventura at the beginning of 2017, the answer would be no.
Okay, we got another one. How does U.S. dollar devaluation factor into your use of a statistic payment price in your analysis?
Generally, it doesn't. So you're talking about maybe how it affects more the foreign investor coming in. And in that case, do I consider it? I do consider it. Have I calculated the difference? One of the reasons why I'd have to say that I haven't is because I can't find it being important enough for its own category. And that happens sometimes. And I'll give you another relationship that you think, okay, well, how come this isn't here? How about rent price to payment price? The ratio of there, certainly that must be important, except for when you do a history of it, you go, well, it's not. So if it's San Francisco, be perfect example. It's the most out of control ratio there could be, even though the rents are high, the payment's enormous. And year over year, they went up 25% when that ratio existed, the price. So there's some categories that seems like, okay, well, that's an important one. It might be important to somebody in China who's having their currency devalued, coming and trying to park their money in a dollar, based asset. That would make perfect sense. It would make perfect sense if you were in Europe and the euro and the pound were devalued, that you would buy less U.S. real estate. That would make sense to me too. But is it the quantity that's going to tip us over? Probably not.
So Corey's asking, so you are saying that Sacramento County still has room to go up?
Yeah, I mean, that's why we do the math. I mean, that's the thing. There's nothing in Sacramento, Riverside, San Bernardino that scares me. You just, when we cover that area in the report, we have to look at that and say, okay, well, why didn't they join the party? The second chapter in the report deals with, or the first one actually, 20 appraised properties. So Rick Solis has over and over and over again appraised the same properties, and they don't touch all the areas, but it's interesting that you have areas that have gone up way past their peak in 2007, and you have areas like Sacramento, San Bernardino, Riverside that are way, way below. And that dichotomy has really not usually existed to this extent. So you usually have high dollar price property go up first, then the money flows out to, let's say from Orange County to Riverside, from Riverside to Victorville, from Victorville to Barstow. That's the progression as money tries to find some kind of sensible purchase price on something to get a yield. We just didn't get our share of it this time in those other counties. So that's part of what we have to look at going forward. What was missing, and is it going to correct itself? And to me, that's part of the story, because the answer is probably no.
I'm going to combine the next question sort of two. One is sort of talking about the dollar then versus now. Is that sort of calculated into the affordability index that we're looking? Is, if inflation is a dollar from 10 years ago, is it worth the same dollar amount today as we're sort of calculating affordability?
Affordability, I just take what the California Association of Realtors spits out. I don't think it is attached to anything other than what it is today. So it calculates what percentage of the households can get a yes answer from a lender, given the fact that they're putting 20% down on the median price. You end up with a loan balance and you apply the interest rate and then you look at the income and you get a percentage. What's fantastic about this chart, it's inaccurate 100% of the time, and yet it has been the most accurate projection for a downturn that I can find. And to me, it's interesting because you can make the case, well, not everybody puts 20% down, and you're absolutely right. It's never true. Isn't that interesting that a chart that is completely flawed can be such an accurate projection? And by the way, I am not stuck on any chart. All it does for me is give me a better conclusion. If I found one that was better, man, I'd use it. And I spent a lot of time in this report, and that's the second chapter on affordability, because there's a lot of people that are pretty intelligent that I respect that really disagree with this. So this time I really went and did a progression of, okay, when this happens, there's a reaction, and I do it over and over and over and over again. And you can tell me at the end of the day which chart told you what was next. And you can disagree with it if you want, but I don't care about which chart it is. I care about avoiding damage. If you find a better chart to help me avoid damage, I'll pay attention to it.
David wants to know about Las Vegas. Any thoughts?
I'm not an expert on anything outside of California, so I hesitate to make a statement. I think Vegas bothers me a great deal. It's one industry that if you were a terrorist, honestly, that would be a place you could damage. You could damage really bad. I would be concerned about that wild card, but also it's the phoniest market that has existed. The foreclosures that could have existed in Vegas completely never happened. They basically passed a law that says you're going to have a very hard time foreclosing. So they didn't. Well, they created a housing shortage. So you actually have a building boom in Vegas while you had 50% of the people upside down. And since they weren't foreclosed on, you didn't have a big ratio of foreclosures. So you literally ended up with a building boom because you had a housing shortage that was completely nonsense. So do I trust that? I don't, to be quite honest with you. And that doesn't mean I'm right or wrong. I'm just telling you what I view that as this very speculative area, maybe even because the first reason bothers me more than anything is that you could have a terrorist event hit a hotel and you could find all the reason in the world to go gambling in Temecula instead of Vegas.
Yeah, true. I'm sure the Indian casinos would love that.
Yeah.
Ollie wants to know, so would you be able to conclude that in the San Francisco Bay Area that it's peaked and should probably sell and buy into these other counties you charted for upside? That's a good question.
It is a good question. The hard thing about a speculative area is that the human being will keep on investing in stuff until it goes down. And so can I tell you that it's peaked? I can't. It's like telling you Bitcoins have peaked or, whatever else the crazy things go on. It's overpriced compared to anything in its history. To me, that's a speculation. So you really have to decide, if you're in Sacramento, you're an investor. If you're in San Francisco, you're a speculator. Could the speculator make more money? Absolutely, until they don't. And that's the danger.
Right. We had a few questions sort of along similar lines about specific areas like San Diego. So you're saying, we're butting up against that peak. And I like that you were very conservative looking at going back a year before the lending got really crazy. So we're looking at 2005, the payment in 2005 before the nonsense loans got us to blow through that. So it's a rather conservative chart, which is good. Yeah,
it is a conservative chart, but it's probably more accurate than the other. So I think it's...
Agreed.
But you think about it, we're still not there price-wise either. As a median price, maybe we are getting close to it. But San Diego, if you're asking me, okay, do I feel an urgency to sell something I have in San Diego in the early part of 2017? No, I don't. Okay, we didn't say that the upside was zero or negative or it was speculative. it's within 20% at 4% interest. What'll be really interesting is to see where interest rates go. And that's one of the reasons why I covered the wild cards, is if some of that materializes in 2017, and we covered this really well in the report, is how that could filter into our economy. And if it filters into our economy and creates a recession, what'll happen to our interest rates?
We got a question about your rentals. I've gotten a lot of questions about that. Did you sell everything? You're leaving California. What's going on?
I have virtually sold everything that I have as a rental. Not quite, but so it's a fair question. The reason I did that is it just made sense. I bought them for, one of them, I'll give you an example, $64,000. I fixed it. I sold it for $275,000. I was able to do a 1031 exchange and end up with 2 brand new houses in a great area for twice the rent. I mean, that makes sense. It happens to be in Florida. I have my best friend in Florida. I'm comfortable with all the demographics about that. So that's why it made sense. Well, did I sell because I thought it was maxed out in Moreno Valley? No, I wasn't afraid of that. I was just being a good investor. I was returning to my investor roots and saying, okay, I want to hold those long term. Did I want to hold the Moreno Valley property long term? No. I bought it with the assignment grow in price, and it did. It went up 3 times or more. So that's to me why I sold it. I haven't stopped speculating. I just started building. I don't know. I think we've built 4 or 5 houses this year, and we're building already 4 or 5 new ones that just haven't even come out of the ground yet. So I'm not afraid of this area. That's just so you know. I mean, again, what's going to happen in the next 12 months to me is insignificant as to what happens in the next 10 years. That's a much more important question that will take me a while to explain.
Okay, we need to move on. We can come back to questions, but I've sort of got to keep an eye on what this will look like on the radio show. So let's get to the table of contents for the report, talk about each of the chapters, why it's there, and this really helps people who've never been to a timing event with us sort of what to expect. So I'm skipping in the introduction, but chapter 1, number 1, 20 appraised property. What's that about? Yeah,
we briefly mentioned that. Rick Solis over the years has appraised properties for us, and we have 20 properties that just like say 1 in Riverside, 1 in San Bernardino, 1 in Victorville, et cetera, and probably appraised it from the peak in 06 or 07 and just did it a few years, every few years. So we have this little trail of what it was worth in 07, 09, 2012, in 2016, and maybe another year in between. And what's revealing about this is how different this comeback is. You don't normally have an area still half of what it's valued when you have another area that's 50 miles away at over 100% of where it was in the last boom. So that to me is interesting. It does tell me that there's a chance to be an investor in some of these areas. And in the report, in another chapter, we talk about why that happened. Now, I want to mention something, and this is not how we normally think in California. In the 70s, early 70s, California in the United States was almost exactly the same median price. About 32, 34 grand. That was the big spread. And then all of a sudden, California went crazy and went up to double and then to 250% of it. Okay, well, here's a good question. Well, what if the stuff that made that happen are not going to be present in the next decade? Okay. And that's what this report deals with, is that, okay, are the elements that made that all happen still existing? And if they're not, why would we be capable of keeping that ratio? And that's why that chapter is so long, is because I'm going to methodically go through 24 reasons why this outcome will be different. Doesn't mean, by the way, that I won't participate in California real estate. I'm just going to understand that the game is different this cycle.
Understood. Okay, chapter 2, affordability, one of your favorites.
Yeah, well, again, the only reason it's one of my favorites is just it was one of those aha moments. I remember looking at it going, oh my gosh, that is, when that tilts over, there's a lot of problems that happens. And that's all it did for me. It was a warning light. And okay, what does affordability mean? It means the ratio of people that can get a yes answer from a lender. So when that gets too low, doesn't that make perfect sense that would have ramifications on other charts? See, I get that. So what happens to affordability, it's usually looked at the opposite way. So high affordability, that means wonderful things. Well, no, it never does. It always coincides with a billion REOs. Now, it's great for our industry because we know how to deal with that. So I look at charts probably in a reverse order than somebody that's got a PhD in economics and says, or has a, high affordability means everybody can buy. The problem is that they don't buy when affordability is high. They're scared to death. And so, but this time we really do tear apart affordability and watch the progression happen. And I ask the question, basically, is this chart an initiation of something else, or is this like all-inclusive in its own? And it'll be fun to go through all that because it's the first time I've actually taken you through the drill that helped me land on affordability being the most important chart to determine a downturn.
Okay. Sales and inventory.
Sales and inventory, very important. That's the thing. Most of the categories, by the way, we kind of rate these 1 through 5, and a lot of these 20 chapters land in the 5 category as really important because if they get skewed one way or another, it can be a big deal. So sales and inventory, the mix of inventory, you've got tremendous upsides, in sometimes when you have downturns, let's say you have a large buildup of foreclosures and your inventory changes in nature. And this takes a really good look at that and what the numbers are as far as, okay, when you're into dangerous points. Our sales really have mimicked something that is very unusual. The last 5 or 6 years in sales for California, while prices have doubled, have almost exactly mimicked the years 90 to 96 when prices went down 20% in California. That's what our sales have done. So here we've had this boom in prices only because we crashed. So it's kind of a weird doubling. Yeah, we gave up 55% to double. So we're really where we were before, somewhat less. But our sales are just not going anywhere. And so then you have to go, well, why is that? Is it going to change? And if it isn't going to change, then what's the future of our pricing power? Okay. Because if you don't have a big pile of sales, it's really hard to push people into unreasonable prices.
All right. Lending,
big issue. Is it going to get aggressive? Is it going to really produce the buyer that's at the margin a lot of times to where we can get a lot of volume? Dodd-Frank, maybe it's going to be repealed, but I think you have lenders getting fined all the time. So I don't know how aggressive they're going to be in the short run. Interest rates, that's a wild card. And for me, this report doesn't attempt to project that as much as it does just take into account if it's 3%, it's this. There's a really interesting progression that we do at the very beginning of that chapter. And it basically is a journey for my life. 17.5% interest at $100,000. What's your payment? Okay. The same payment emerges at $350 at 2.5. So that's how important that answer is, but who knows what it's going to be. Next is employment. So you've got pockets of employment that are doing great in Northern California, and you've got construction employment virtually not showed up in Riverside, Sacramento, all those areas. Okay. Aaron's got a real important chapter in this report, and it's going to talk about how things might change in the next 10 years, about how you're employed and if you're going to be replaced by something called a robot. Trustee sales, again, I look at all the ratios of the past and say, okay, how could you have 3 downturns and yet you have one in the 80s or early 80s, no price hit, 90s, 20% price hit, and in 2008, 9 and 10, 50% price hit. What was the difference? And we find the difference is in the ratio of trustee sales to sales. And then we'll project what we think is going to happen with that going forward. Construction and commercial. Construction hasn't done very much. We almost missed this cycle for single family homes. They, in the commercial side though, built a lot of apartment buildings. Commercial real estate is about 126% of the peak. So overall it's much stronger. That breaks into some categories that have gone crazy. Storage units have gone up 180% if you own not an apartment, but if you own a hotel, Airbnb has kicked your butt and it's gone down. So it's not an even sum game. The question is, are the cap rates that people are paying really creating a value for them, or are they going to be, if you have interest rates go up, is that going to be a big negative? Retired readiness, just looking at the people that are retiring, their net worth, how much problem that could be going forward, and how unlikely it is you're going to take anything away from this group. Demographics and migration, just showing that we're definitely going to have this great group of people turn over 65 and all the things that matter math-wise to that. The next two chapters, pension math and national debt. This is, after I look at this chapter, I changed the chapter title or the title report from 30 trillion to 40 trillion, because to me it looked like we were probably going to do that. And one of the reasons is the presidency and the past financial outcomes. So we took a look at when a Republican president comes into office, what do they do? Well, he's role playing. He's doing it just the way they do. Let's cut taxes. Well, that's great. It's going to create less revenue so that the bill will go up as far as deficit, where we do something smart with it. And we're going to have a lot of infrastructure spending. So all of those things come into play with saying, okay, could you have a $40 trillion deficit and things be okay? Yeah, you could. You just spend the money on the right things that create a future profit for infrastructure. That makes sense. Already talked about oil a little bit. Aaron's going to take the chapter on changes due to technology, and that's a chapter that's over my head. So I'm glad he's doing it. And then rentals, and at the end we'll talk about where we end, where we are and how we end. And that is a lengthy chapter of about 50 pages. And at least you'll feel like, okay, I've explained to you where I landed and why I felt it was comfortable to say 10 years out, here's where we'll be. The last chapter, top timing takeaways. So 30 tips and aha moments over the last 20 years for me.
Okay. We ended just in time, which is great. We'll continue with the questions, but we needed to tighten that up to make sure we could fit this on the radio show. So we're going to go back to the questions. If you want to see the newsletter with all the charts, because we flew through some of those, especially by the county, just go to the norrisgroup.com/2 and then %, all one word, the 2%, and you can find that. Okay, leverage. As you change your rentals in California to Florida or based on the market conditions, do you recommend using leverage? Personally, I'm 64 years old, so I virtually have no leverage, but that's just because I don't care to have it. I don't say, okay, gosh, I could get twice as many or 4 times as many. Would I use leverage? I would use intelligent leverage to make sure that I don't have a problem with payments in almost any case. One of the things that we've spent some time this year on is going back to Washington, D.C. twice. And so I really think there's going to be a new attitude toward investors, because it is going to be the main growth area for housing. So if you're a lender, you might want to get good programs with fixed financing for investors. So I do think that's coming within 2 years. I think Fannie Mae will open up the doors. Instead of 4 properties or 10 properties, it will be a number much different. We have quite a few questions that we might be able to hit all at once on rental markets, from San Francisco to, what are you thinking rents are going to do?
What do I think rents are going to do? I think there's going to be more demand for rentals than there is going to be for occupant owners. So it really will depend. I think we're in for a recession in a couple of years, inside of a couple of years. So generally what happens is you lose migration in any of the areas in California. Sometimes it's less severe than others, but it's a little hard to have rental increases while you're losing people. I don't know that I would count on a lot of increases going forward. There's a point where you just, okay, that's it, especially if you have migration loss. So, and some of the prices, if you're going into a rental market, I can't imagine wanting to be, my first investment be in San Francisco, even though I could rent a 2-bedroom condo for $5,000, I wouldn't want to pay $2 million for it and have that make sense. So there's a point where you just go, okay, well, I really don't think I'll start here. I don't know if that helped. I just don't see rents being a really aggressive for the next couple years, because they've really been aggressive. All the charts in the rental chapter show that we've had some pretty healthy gains. Some areas, just ridiculous gains.
All right. Well, thanks so much, everybody. Go to thenorrisgroup.com/2, the number 2, and then % for more information. And I will place this entire video there. Thank you so much for joining us for lunch today. And hopefully we'll see you February 4th.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.